From the morning reading, spiders, diamonds, Qs make all-time new high close. IWM hits a 52-week high as oil continues a 2-week rally. 7 of 9 sectors moved higher on Monday. XLB, XLE, and XLF were the strongest sectors, while XLU was the weakest sector. Oil futures rose $1.02 to close at 45.71. Breadth strengthened compared to the prior session as advancers led 1927 to 1057 on the New York Stock Exchange and led 1766 to 820 on the NASDAQ. On the S&P 500 snapshot, of course, another record close. The Dow, NASDAQ, and S&P 500 all logged record closes. The preferred benchmark, the S&P 500, rose at the open as the pre-market futures indicated and rose to an 0.45% intraday high in the late morning, a record intraday high. The index slowly drifted lower to its 0.28% closing gain, which was more than enough for a record close. A 0.09% gain would have done the trick. The closing yield on a 10-year note rose 4 basis points to 1.56%. Utilities are not going along for the ride. In early July, we examined several reasons why defensive stocks, utilities in particular, were likely to see some underperformance in the weeks ahead. And now the Dow Jones Utilities average is down nearly 6% from its high, while the industrials climbed to a new record high. Prior negative divergences in the utilities led to a modest drag in the industrials, but utilities continue to perform even worse. Breadth momentum has been waning. For the almost 3 weeks now, the McClellan oscillator has been negative, even while stocks have pushed to new record highs on several of those days. New highs on waning momentum have led to modest short-term weakness in the S&P 500. Dumb money confidence continues to grow. It's now above 80% for the first time since December of 2013. Since 2000, when the confidence was above 80%, accounting for 4% of all readings, the S&P 500's next day annualized return was a negative 4.1. That contrasts when it was below 20% and the S&P's annualized return ballooned to 865.9%. That doesn't mean that there weren't some winning days when confidence was high, but overall it was a losing strategy to be long the next day when it was so extreme. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market volume, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:38 a.m. Mountain Time, and I'm recording this in preparation for the market day of August the 16th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. At the time of this cut, all 4 broad market indices were down just below scratch. Crude oil was up about 0.6%, euro is up about 1%, bonds were up about 1/3%, and gold was up almost 1%. In overseas action, China down about 0.5%, Hong Kong just below scratch, Japan down sharply about 1.6%, Germany down about almost 1%, and United Kingdom down about 0.33%. In macroeconomic reports of note for today in the United States, we have housing starts, capacity utilization rate, industrial production. Looking forward to tomorrow, we have the weekly crude oil inventories. We have FOMC member Bullard speaking, FOMC meeting minutes. So that should cause a little bit of action and certainly some financial press for tomorrow. In terms of looking to current volatility conditions, our short-term VIX now below a 10, 9.72. Skew somewhat elevated. It's certainly in the caution area to 134. IV percentiles continue to be exceptionally low. You have the S&P at a 2, the Russell at a 3, the NASDAQ at a 3, and the Dow at a 2. There was one index with a standard deviation move put in yesterday on a close-to-close basis, and that was the Russell. Okay, let's go ahead and take a look at the charts. On our S&P futures charts, we see yesterday did indeed have both an intraday new record high as well as a new record close. We've given back much of that so far in the overnight activity today, but both of these are relatively small range candles, has been mostly the case of late, and so I wouldn't make too much of this at this point, especially until we get the broad market and cash market participation coming into play. Now, you heard one of the morning authors note about this dumb money confidence and so forth, and certainly it's just another sign that we could be coming to something of an exhaustion kind of pattern and have something of a retracement set up. And that retracement, if you look at where we started this move post Brexit, we were in 1981. We are now 200 plus points away. Even frankly, a retracement of several percentage points that would bring you back down to say 2100 would not even damage the intermediate term bullish trend that we are currently in. Now, you wouldn't like to see ideally that a lower low from this swing point here, but just keep in mind that we're very much due for a retracement, and probably something more than just, you know, a one-day retracement like we've had a few times in the past several weeks, but actually a real retracement, and that would actually in many ways be healthy for a continuation of this bullish trend. So just something to kind of keep in mind there. On the Dow, also yesterday, new intraday and closing highs, much of it being given back so far today. So very much the same pattern that we have had in the S&P 500. The NASDAQ, which finally has kind of caught up and is setting its own new highs. You see the just rip your face off bullishness that has occurred in the post-Brexit period with the NASDAQ, and this has been further accelerated by some companies coming in with some really nice earnings. So even when the S&P and the Dow have had something of a little bit of a pause or pullback or gone sideways, the NASDAQ has continued to basically rip straight up. Definitely could take a retracement of several percentage and not hurt that pattern at all. Now, the one that does need to catch up is the Russell. And the Russell, while you do have, you know, a new 52-week intraday high and closing high, we're quite a bit of ways away still from the all-time highs. And we'll take a quick look. I think we can pick it up on the 2 years. Yeah, see, there's 1292. So we're still some 50 points away on the Russell to catching up to where we would be in relative terms on the other three primary indices. So just kind of keep that in mind. It certainly has made a big move itself. Also hasn't had much of a retracement. You had a one-day pullback here, and you know, perhaps a one-day pullback here, but very quickly invalidated those pullbacks and surged forward once again. So there's not been much relief for anybody who is trying to be short on the Russell, you know, for several weeks now, and really that probably can be said for all the indices. Let's take a quick look at some of our other markets. Crude oil, of course, has been setting a short-term pattern of higher highs and higher lows, and seems to be correcting the breakdown from that prior wedge pattern. Still lots of overhead resistance here. Got to get through the cloud and other overhead resistance, be able to set up something that looks more like a true intermediate term bullish trend. In terms of gold, of course, was toying with the bottom of this triangle that we had drawn. We talked about this yesterday. We'd had that prior close. It was just undercutting. And then we had a follow through that, came and closed right up at the backside of that with a little bit of trickle action intraday back into the triangle. Well, so far today, we've had far more confirming kind of action. And frankly, if we don't see something break out at the top of this apex in the next session or two, we'll probably redraw this. And this is probably denigrated into another classic gold sideways pattern. So we've talked about this over and over again in recent weeks. You've got a situation where gold has been some really ugly chart patterns this year, and that this would go sideways before breaking up, would not be terribly surprising. We've got to be very, very patient. If you're going to be a gold trader, you're going to have to be very patient to see your resolution in the direction of expectation. It has been that type of market this year. And in terms of bonds still in the sideways consolidation chop, and now actually into the cloud, which would characterize this as a neutral pattern. So something to kind of consider there as well. If we finally do break out and have bonds take off to the long side and continue the prior pattern, we probably also at the same time see the equities break down and give us the retracement that we've been looking for as well. So no signs yet in any of these markets that break up or down as you would expect from the various markets and their normal correlations. No indications yet that any of those things are imminent or about to happen. And volatility, a little bit of an uptick, with the weakness in the overnight, but certainly nothing to get terribly excited about. We're still exceptionally low. And really, we consider anything below 13 to be kind of interest, and below 12, it actually starts to affect our trading, and that the premiums that can be received are so low compared to the relative risk. So we're certainly coming back up above 12 at this point, so that's something of interest. We'll see where that action closes for today. That's still intraday action. Let's go ahead and go back to our daily report. And of course, here at the beginning, we review our opinion for market timing using a number of mechanical signals. First of all, from IBD, we have confirmed uptrend. That is bullish. From GMI index, we have a 5 out of 6 with a buy signal that's been in place since 7-1. Note that GMI 2 is still an 8 out of 8. That's more sensitive usually than the GMI index. On our third mechanical signal, the stock charge decision point scoreboard, again, still mixed signals here, and this is our primary fly in the ointment, as it were, on our market timing signals. We have in short term across the various indices mixed signals, and we also have in the long term still mixed signals. So consensus of these signals is a bullish signal, certainly a bullish bias, but you got to pay attention and take note of these mixed signals. This can cause an expectation, certainly, of choppy markets, and we certainly have seen that in recent sessions. While we're making this bullish bias valid with some intraday and new closing highs, they've been largely incremental, and with low volume, very low volume, and low volatility, just small incremental moves up, along with that also small incremental moves down periodically. In terms of the position sizing models, both the portfolio investor position and the active trader based on volatility models, are still showing us at 100%. Intermediate term market posture is severely strong bulls across all four indices, and you see they're all essentially at 95 or better, so cannot hardly score stronger ratings. This is reinforced with the bullish sentiment line, so our expectations are that bull legs are stronger than the bearish legs. The strength of the current trend, very, very strong, no changes there. Hedge warning status, our current hedge warning status comes in at a level 0+, which is defined as normal with some cautionary aspects. Those cautionary aspects are mostly referring to the stock chart's decision point scoreboard status with its mixed signals coming at us on market timing. In terms of special opinions, our option income strategies, that VIX is borderline acceptable to initiate new positions for novice traders, being that yesterday's close was below a 12. The amount of premium received versus the risk is something of a problem for novice traders, so kind of keep that in mind. At some point, obviously, we're going to see an expansion of volatility. That could take a while though, so just because it's low doesn't mean it will happen today. Our other two opinions, covered call strategies and put selling, conditions are acceptable to initiate new positions for novice traders in both of those strategies, and relatively aggressive at this point, considering using 1-to-2 ratios in the money and out of the money strikes on the covered calls, and a 1-to-2 ratio of low beta versus high beta positions in the composition of that portfolio. In terms of put selling, you might want to be mostly focused on developing their watch list or on individual charts looking for pullbacks, but kind of difficult to initiate a lot of new positions if you're a put seller when you're plugging all-time highs and you've got things like that dumb money confidence score, being so high. You have to kind of think that at some point we're going to get a retracement. You're going to get a much better opportunity to initiate new positions for a put selling strategy. So consider that. So if you're putting on new, a few here and there, and then wait with your capital for a better opportunity. In terms of specific warning areas in our volatility cluster, you see we have 3 that are currently in warning status, same 3 we've had for a number of trading sessions. We've got this low grade warning with the volatility ratio warning being in the firing prone area, but not yet having fired. Also, we're in a VIX daily squeeze. It's just another way of saying we're expecting an increase in volatility at some point in the future. Skew is elevated, and we're running about a 10% probability of a 2 standard deviation move in the next 30 days. And our trend-based group, all very, very strong. Nothing in warning. In fact, these are all strong bullish signals. Key intermarket risk aversion indicators, all 5 are still in that risk on status, but no change from our discussion yesterday in that some of these are very much wrapped sideways, and at best, these would probably best be described as neutral. In terms of sentiment, we do have sentiment warnings coming at us, both in the short term and intermediate term for stocks. And then also in the fear and greed index, we are clearly up in the upper quartile and showing an extreme greed rating of an 81. So remember, sentiment can be extreme for prolonged periods of time. Mostly what this is telling us is to look for reversal combinations, candle patterns and the like that give us reversal signals. But until we actually see those reversal signals, high sentiment readings are not generally something that you act upon. In terms of sector specific, we continue to see telecom, utilities, and industrials as our 3 weakest sector. Note also in particular a couple of our stubs, with the utilities and telecom being weak. This continues to be a market where the defensive sectors are taking a little bit of a hit. In terms of yesterday's action, you see the heroes were materials, industrials, energy, financials. So really all the high beta areas of the market were doing well, whereas again, here's the stubs, here's your defensive sectors are all the lowest performers, and indeed utilities giving up about 1.5%. Also note utilities on the 5-day, 1 month, relatively consistently down. One of the morning authors also was commenting about that as well. Well, we're right up against 20 minutes, so we're going to go ahead and wrap this up for today. And let's go ahead and hit the disclaimers. As always, if you need more time to review the disclaimers, just hit the pause button. Also note the hyperlink down here at the bottom for the full set of disclosures. In the meantime, manage your risk, and if you do that, you'll see that everything comes into play. Go out there and try to learn something each day. We'll see you back here for the next Falcon Global Market Preview session with tomorrow's trading. Good trading.